Hello, everybody. Kirk Spano, Monday, March 27th, stocks of the week and retirement income options. But we are going to take a little bit of time to discuss the big macro picture out there. And I'm getting my quarterly outlook and game plan put together. I've done a little bit of reorganizing yet again, just keep moving in the direction of simplification. I don't know if that comes from getting older or wiser or lazier. I'm not positive. And we will be talking about earnings are likely to come in flat to slightly declining based on the last quarter and the forward outlook. We got the first breakage in the banking sector. Real estate loan resets the next couple of years mean more pressure on banks is coming, which I think supports the thesis that I've talked about, that we are going to see M&A in the banking sector. If you saw Mark Lazary on Bloomberg the other day, he talked about why would anybody keep money at a small bank with the FDIC limits so low. So I think we are going to see FDIC limits rise, but we'll see how they structure it. I think the Federal Reserve is doing a good job supporting the banking system through this period of transition to the new normal. I think that this can rightly be called the Great Normalization. That will be the title of an article this week. And I think that the stock market is going to throw in the towel at some point. I think large caps have at least 10% downside and up to 30% downside. At a 30% correction, that would take us just a little bit under 3,000 on the S&P 500, which is what I projected in my start of the year letter, my futile forecast. I thought it'd be cute to put the definition of bank run at the top of the article. And I think that there are some signals right now that support the idea that there's a pretty big drop in stocks coming. Again, is it going to be 10% or will people panic and drive it down 30%? We'll see. So this is from Forest for the Trees. Interestingly, it's something that I've been tracking a long time and I just haven't shown to you. I was going to show it to you this week. These guys beat me to it. But there is a volatility index for bonds that whenever there's a big divergence, and they're showing it to you a different way than I will, there's usually a corresponding drop in stocks. Now, I don't think the lines will match up exactly. I think that the SP 500 gets down to around here, most likely. But then we do have that panic scenario. This is how I've been tracking it for a very long time. As you can see in the early 2000s, as this bond market volatility index declined, price of stocks went up. As volatility went up, we got the financial crisis. Then as volatility came down, we got the big QE led. But you can even see when there'd be a jump in volatility, stock market reacted. So bond market volatility leads to stock market declines. They don't last forever. As you can see, I mean, you take a look at this and you can just go, well, those dips aren't that big of a deal. And that's one reason why, as long as you don't panic sell at the bottom, you're generally going to come out of things okay a year or two out. So that's your big challenge, is don't sell when the panic is going on. If you panic with a stock market correction, you're screwed because you'll never get back in at the right price. I mean, 9 out of 10 times you won't be able to buy back in lower. You're going to panic at just the wrong time. If you want to sell any of your stocks, and I've been cleaning up positions, been showing you that in the articles with selling covered calls, trimming positions. I'm going to talk about that in the articles today. And I will have all 3 articles done today that I have coming. They're all pretty far along. As you can see, big move up in bond volatility for COVID. You got the COVID crash, and volatility has been going up since really the end of 2021. Since the end of 2021, we got the bear market. And then we got a drop in volatility. I'll call that a hopium drop. And we got a little bit of rally so far this year. Not much, just a little. And now all of a sudden, volatility has jumped way up in the bond market. Stock market hasn't followed yet. How far down it goes, anybody's guess. I think right in here is a given. I have a hard time thinking that we won't see around a 10% correction. But do we see a drop all the way down here to this level, give or take? A little below, a little above. So from here to here, I think is your danger zone. And you've seen my S&P 500 chart. There is always the Nouriel Roubini, Jeremy Grantham, end of the world for 6 months scenario. We'll see. Most of the stocks that we currently own are small and mid caps that are already down 70, 80, 90% from where we started tracking them and then started buying them. So, generally I start to buy those stocks after they've dropped 50%, but sometimes they drop another 50%, such as life. By scaling in slow and wide, you don't get hurt too bad. And by selling the options over and over and over again, some of these little rallies, your options expire and you just keep the cash. So that's why we sell cash secured puts and covered calls repeatedly, because dropping that money to the bottom line helps you accumulate more shares at lower prices, one way or the other. And at some point, there is another bull market. And I think that starts sometime this year. So let's talk about the banking sector a little bit. One of the things to consider with the banking sector, and this is a pretty historic picture from the crash of 1873, is that the Federal Reserve is really making it easy for these banks to refinance their balance sheets. And that should be enough. Now, is it truly quantitative easing? Not really, because the banks really can't lend the money out because they were in deficit, right? So their balance sheets were upside down. They're not going to be able to loan out a lot of that money until interest rates come down. And I don't see that happening for a while. Another article that I'll write in the next week or two is going to be titled, "The Fed Bazooka is Loaded. Don't expect it to fire." If you'll remember, one of the articles I wrote, I'd say a year and a half ago, was the Fed is reloading its bazooka. In fact, I'll pop that up there for you. Way back in December of 2021, I told you the Fed is reloading its bazooka for next time. They don't really want to use the Fed balance sheet for straight quantitative easing until they have to, which is when the baby boomers really put stress on the Medicare, Social Security systems and the economy in general, because they're all going to be retired by the end of the decade. That doesn't mean that we won't see quantitative easing. However, I believe that the official policy will still be quantitative tightening with help as needed. So right now, we are getting some of that help as needed. Fed balance sheet, as I showed you last week, rose about $300 billion, but that was a blip. They're going to keep buying back bonds on a monthly basis. So you're going to have this duel between quantitative tightening as a policy and, I don't want to use the word bailouts, quantitative easing as refinancing for the banks. That's the right way to think about it. So you have quantitative tightening as a policy and quantitative easing for the refinancing of bank balance sheets. And as these bank balance sheets become even again, as they get back to par, and a lot of these banks are going to have to issue equity. They're going to dilute them by some amount to make up for the loans they take for the Fed. So if they have to borrow $10 billion from the Fed, at some point, they have to pay it back. Interest rates coming down a little will close the gap, but they're going to have to dilute. So you're going to see a lot of the regional banks diluting. And it's not going to be huge in most cases because a lot of the banks were keeping a lot of their money short term. They don't have 30% gaps in their balance sheet like Silicon Valley Bank did, or 30 billion that First Republic has. Now, First Republic has borrowed $30 billion from Citigroup, JP Morgan, and I think Bank of America. I could have the three banks wrong. But at some point, they have to figure out how to repay that $30 billion. Again, if interest rates come down a little bit, that, because the value of their assets go up, helps, but they're still going to need around $30 billion. So let's talk about a few things here. Then we'll come back to First Republic in particular. So we know that large caps probably have to come down a bit. I'm going to talk about Bitcoin here in a second. So let's start with gold. Back here, I wrote an article at the start of 2020, but I had actually talked about buying gold way back in 2018. And then I updated it in 2020. So there's a big bull market coming. While we were invested in gold in 2018 and 2020, What did I suggest? I suggested that the gold stocks were the place to start, but that eventually you'd want to end up in gold. And that's where we are now. The gold stocks, the companies, and all you have to do is read Newmont Mining's material and you'll get a complete picture. Or Barrick Gold. Both of them tell you the whole story. You don't have to read anything else. But if you read their reports, it's very clear that just like shale oil is getting hard to get to, finding more gold to mine is getting harder. So the value of gold is probably going to correct here in the short term, but then it's going to break out to new highs sometime this decade, and it could be substantially higher. Now, here's the problem. The odds of gold going to, say, 5,000 are pretty slim just because of the supply and demand dynamics. Even though supply is going to flatten, right? They're going to have very small to no supply increases year over year for the next decade or so, it looks like. That's real. That's what the data says. So if they produce the same amount of gold on a year over year basis for about the next decade, and then gold supply starts to tail off, what do you have? You have a pretty good picture for a supply and demand imbalance by the 2030s. India consumes a lot of gold. So does the rest of the world, but India is an outlier on a per capita basis. But I will tell you, which I've told you before, just like classic cars, classic muscle cars are going to become scarce. If you noticed over the weekend, GM said they're going to stop building the Camaro. Gold is going to become scarce on a relative basis. At some point, you'll get a FOMO rally, but one way or the other, the price of gold is probably heading to around 3,000 an ounce. We're at about 1,800 right now. And I advocate a little bit of trading in this ETF, but what I really want you to do is keep any gold in your family that you have in your family. If somebody passes away, gravitate to the jewelry if you can. Don't beat anybody up. I've seen that happen. But gold jewelry, like over at First Dibs, that I showed you a minute ago off air because I'm shopping for an engagement ring, is going to become very, very valuable. So if you want a hobby, if you want a side hustle, and you have the interest and the capital to do it, just start buying up gold jewelry because it's going to become more and more valuable. If you just want to accumulate some coins, buy coins, err on the side of older coins. They don't have to be, gold doubloons from the 1700s, but if you can get gold coins that were minted just, at least 20 years ago, in the 1900s sometime. Yeah, the 1900s. Sounds funny to say that, right? Do that. If you can get old European coins or South American coins, anything that offers some antique value or some collector's value, that's awesome. The little 1 ounce gold bars, those are pretty cool too. Then you have to decide, do you just want to pass these on generationally, or do you want to, open up your own little shop on First Dibs or some of the other secondhand stores? There is very big money to be made if you're interested in doing it that way. I'm probably going to start accumulating classic cars once I have a hunk of real estate to put them on. And I would like to get into jewelry. So when I talk to Jolene about what her next job is, which is about a year overdue, I talk about those things because she really doesn't want to get back into corporate America. She's just worn out. And I tell her, well, you like interior design, you like real estate, you like jewelry, figure something out. You already know how to market yourself because she was in marketing. I would say the same thing to all of you, is if you want a side hustle or you just want something cool that you can keep, if it's in your interest range, gold jewelry and old muscle cars, probably what I would tell you. So the Fed's bazooka is basically loaded. Will they raise interest rates in May or not? I don't know. If they can, they will, because they're still fighting imported inflation from Russia, OPEC, and China. It's very geopolitical in nature. Most people don't talk about it. I talk about it all the time, but it is correct. The Fed isn't fighting inflation anymore that's based in the United States. They're about to win the war on inflation from real estate. You've already seen all sorts of measures of inflation get back to basically par. Even food inflation in the United States has kind of leveled off. Now, the prices of food haven't come down, and I don't think they're going to. I don't think you're going to see cheaper eggs. I just don't think they're going to go up anymore. And I had an egg farmer as a client, so I actually have weird insights into eggs. I don't think you're going to see the cost of beef and chicken go up anymore. There's been a huge build out of chicken capacity, even though they had the big die off last year or 2 years ago, whatever it was. The war on beef seems to be ending. People are like, look, I'm going to eat less beef. We're going to have our meatless Mondays, but I'm still going to have a burger at the barbecue, or I'm going to have that steak on a special occasion. I think the supply and demand for all of these different types of proteins are all kind of evening out. You have a little bit more veganism. You have a little bit more vegetarianism. You have people like me who are trying to eat fish 2 or 3 times a week, having at least one vegetarian day a week. I would love to try to do 4 or 5 vegetarian days a week. I have a hard time with it. I get 1 or 2 a week. That's pretty good. And I think there's a lot of people who are looking at it that way, especially the millennials. I have a lot of millennial friends through baseball and poker. And it is not uncommon for me to see them after a few months and all of a sudden they're 20 pounds lighter because they're like, yeah, I cut out a bunch of the sugar. I'm not drinking as much. And, we don't have meat every single night. I think that's a big trend. This isn't a fad. There is a slight improvement and leveling out on diets. And that is a big deal when it comes to inflation. Your services inflation is probably the one thing that's going to stick around. People getting paid more in wages is good inflation. Do any of you want to earn less? No. Technology is going to change things. There was a discussion on the message board at Margin of Safety Investing about how AI, and this is something that we've been talking about since CES 2020 again, how AI is flattening out different cost structures, right? Getting rid of a lot of middle management, but the AI now can develop the software that all these coders were doing. So there's a lot of people who are probably going to earn less in tech, but they'll still be very employable. So you take a look at how these cost curves are working, and the technical skills are still necessary. You still make a very good living, probably not going to get super rich as fast for the high-end people, and for everybody else who, I know a lot of people in California who at 40-something years old have a couple $1,000,000. And that's a pretty fast rise compared to people in most other jobs. But I don't think you're going to see quite the pay scale and bonus structures in the future for that as you have in the past when there was a shortage of coding. Now the AI is going to really close that gap. But services, if you're providing a service to other people, right? If you are mowing the lawn, if you are working in home health care, if you are just working behind a counter somewhere, those jobs aren't going to be $8, $10 minimum wage ever again. So the floor has risen, the middle has spread out, and we'll see what happens at the top. Usually the top doesn't take a nick, but I think the day is coming where a lot of the loopholes get closed for avoiding taxation when you're already making a ton of money. So we'll see how that goes. One of the reasons why I think Bitcoin is a big deal is because people who have money, who hate the idea that they get taxed, are going to keep using Bitcoin. There is going to continually be a shell game when it comes to tax avoidance. And having money in Bitcoin, in dry storage, dry cold storage, whatever you want to call it, cold storage, is going to continue. And because the United States is just going to get stronger and stronger as the price of energy comes down, right? The petrodollar doesn't matter so much anymore. Cheap energy, think about what our economy does when it has cheap energy. It just runs on all cylinders, right? If our cost of energy at home goes down, you are going to see a mega boom. And I think that the cost of energy is really going to start falling in the not too distant future, 3-4 years out, 2026, 2027, right in there. It's just that little window between now and then, especially between now and the presidential election next year, that they have to fight off the OPEC, Russia, China energy inflation. Then after that, panic pumping and, another 10% of the cars sold being EV. It doesn't take a lot to see that by 2040, there's going to be almost no ICE vehicles on the road. And by 2030, almost none will be being sold. So this is not slow-moving stuff. And remember, the market looks forward. So the Fed has mostly won the inflation war already. But as energy falls, until they have a crisis again with the baby boomers, I don't know that they have to fire this bazooka. So speaking of Bitcoin, here's this next gen internet ETF. It's one of the ones that I want to focus on. Why? Because some of the top holdings are Square, which is a big Bitcoin holder, but I know Square inside and out. And I have told you all the things about executives skimming their companies for years now, right? Jack Dorsey's no different. All these executives skim way more than they're worth. There's no way Jack Dorsey should be a billionaire, but he is. It's all money that came out of the shareholders and the customers. But it's a great freaking business. And there's only going to be about a half a dozen companies that control all that online revenue, right? All that business to consumer and a lot of the business to business. So it's a great business, and they've bought Bitcoin. And now that Bitcoin has risen again from the bottom at the end of last year, which is when I told you to buy it, now all of a sudden they're up, I believe, about 40% on their Bitcoin holdings. And if I'm right, and the wealthy continue to use Bitcoin as an alternative asset, as kind of a golden currency passport, and as the emerging markets hedge their dollar exposure by using Bitcoin, because, our enemies use it, and then the emerging markets can bridge the geopolitical gap between the United States and, anti-United States. They can play both sides of the fence. So when the dollar spikes, their economy doesn't get destroyed because their currency gets crushed. They just use their Bitcoin reserves to buy other currencies. And they trade in that direction. So while the dollar will be in a permanently higher trading range, and I think we've seen the top for a while, Bitcoin is going to become an important hedge to the emerging markets, which is where 3/4 of the growth will be over the next generation. Back in the napkin, I can't figure out a way that Bitcoin doesn't go to 300,000. Back in the napkin. If you take a look at Kathy Wood's projections, same thing. And she says spike potential to well over 1 million. Now, if Bitcoin gets to over 1 million and you own some of it, you're going to want to sell, 80% or 90% at that point. And I know it's hard to imagine those numbers, but it's probably going to happen, right? Don't think about Bitcoin as, it's going to, they say it's going to replace the dollar. No, nobody in their fucking right mind says that. You got some hype pumpers on Reddit and Twitter and wherever else that say stupid things like that. Very simple hedging argument. Emerging markets need it. They've already started to embrace it. They're already buying it. That's probably who the hidden bid has been, as well as the Saudis and the Chinese and the Russians. Bitcoin is a thing. Get it out of your mind, okay? Get it out of your mind that Bitcoin is not a thing. It is, and it will be. That's all there is to it. Stop thinking you know something you don't know. There's known unknowns and unknown unknowns. This is neither. Bitcoin adoption will drive the price up, and Bitcoin adoption is happening. Not speculative, it is happening. This ETF is a sneaky way of getting Bitcoin into your IRAs and owning companies like Shopify and Square and Coinbase off of what will probably be generational lows. Somebody asks what I think about the Hindenburg report. He said, years after I said, that all these companies were getting skimmed. I mean, I don't know how many of you have been with me for years. It's most of you. But I've been talking about how the executives skimmed those companies for years. He didn't say anything new. And the revenue appears to pass pretty hardy accounting scrutiny. So I'm not too worried about that. Could there be backwards adjustments? There could be. But if the money's in the bank, the money's in the bank. So I don't think that Square has a lot of downside at this point. I've showed you the chart on Square. In fact, I have it over here. Let me show it to you again. Good grief. There you go. There's Square. It's already taken its hit. Why didn't he write his report here? He says he was working on it. Why did he write his report here? He just wants to see a final bottom on it. Could it get into the 30s? Absolutely it could. But is it going to go back into the hundreds? Yeah, it is. This is the hype cycle defined. What does the hype cycle look like? It looks exactly like this. You've looked at the Gartner hype cycle before. Then it's just going to go like that. For years and years and years, this is going to rise. So you should be scaling in. Again, if you don't own any, I'd say, buy the next dip and see what happens. Maybe buy the next dip and sell a put. And you have just a little bit of dry powder in case it gets all the way down into the 30s. Right, the trough of despair. We're in the trough of despair. Could it get more disparaged? It could. In fact, it looks like it will. I mean, a price in the 40s is pretty juicy. And again, it's held in here. This is a shooter's chart for ARK, mid-30s. My chart, mid-30s. I mean, we were within $1 on our targets. And he uses Elliott Wave, and I use I use more just volume weighted dollar flows. I talked about who should buy Bitcoin Trust back in November. If you had bought this back then, you'd be up, 50%, give or take, because the discount has closed a little bit and the price of Bitcoin has gone up. That's not bad for 4 months, 50%. No. All right. So we have the March options expiration update a week late because I was waiting to see what's happening with the banks. I'm almost done with this. So I'm done with the top part, working on the bottom. Then I have 3 ETF option selling ideas: the ARK Next Generation Internet, ARK Genomic Revolution. Why do I use this one? I use the ARK Genomic Revolution because investing in small and mid-cap biotechs is really hard. It's very time intensive. Now, if you know something about some of the top holdings that they own, and you're like, I want to overweight this particular one, go ahead and do that. But make sure you have a very deep understanding of the company. Usually some professional background helps, or having been through the ringer with similar stocks. The Spider Regional Banking ETF, Shooter and I once again came up with a price in the mid 30s on this one. So I'll put his chart in here too. But mid 30s seems to be the right price. You've had the big drop off. There's going to be a little bit more dilution, a little bit more panic, a little bit more lack of understanding. But just understand this: they are not going to allow this to spiral out of control. Everybody knows what's coming. Everybody knows there's a wall of commercial debt that has to be refinanced at higher rates. That is what's going to control inflation for the next 3, 4, 5 years. And then it's going to be cheap energy. This is just a transition to the cheap energy future, and probably a massive, massive bull market and economic expansion once we're through this transition. And I think the bull market starts this year. As people start to see that the Fed's going to handle this pretty well, and I know that's not the popular narrative, but popular narrative has been wrong about the Fed forever. Everybody calls the Fed stupid. Nah, man, the Fed just doesn't tell you the truth, and you get mad about it. I'm telling you the truth. History has proven me right for 20 years. Somebody asks about First Republic Bank. I sold the $5 puts on that on Friday, so that'll be in this article as well. And you have to be kind of a risk taker. But here's the scenario I see for First Republic. I think they dilute by a lot to get back to even. They're going to have to raise $20 to $30 billion. The stock was 140 or something at one point. It's down to 14. So it's already fallen 90%. The dilution probably doesn't hurt the stock price for more than a hot minute, because they'll go from not good to good, and they're already down 90%. I'm writing an article that Berkshire Hathaway should be the one that buys this bank, because they could turn it into a national bank pretty quick by absorbing other distressed banks. So First Republic operates from the Midwest to the Southeast. They could add banks across the country heading west. We already saw the Silicon Valley Bank got bought by Citizens, First Citizens. You're just going to see a lot of M&A. So I think the easy way for most people is to sell options, sell puts on KRE. If you want to get into individual securities, I think First Republic. And as you saw in the plug and play dividend stocks, I really like Fifth Third Bancorp. I think that Fifth Third is one of the strongest ones. They will be a bank that is an acquirer. They're going to end up buying other banks. Fifth Third is going to become a national bank. The bank that bought Silicon Valley, which was the second biggest failure in history, was the 30th biggest bank in the country. And they're going to jump up to around 12th or 15th or something. Fifth Third is going to keep getting bigger. First Republic, once it's recapitalized, I think they're going to be in really, really good shape. They have the right footprint for revenues now and revenues in the future based on migration patterns. And as they expand west, which they will, that's their goal, they're just going to keep doing well. And there's going to be banks that need to be acquired. It's not going to be like 2009. However, a lot of the small banks that have commercial loans and commercial deposits, they kind of hover at the top end of small banks. They have to get acquired because they're never going to get enough FDIC insurance to cover all those deposits. They're going to need to be part of a bigger organization. The little banks, the really little banks, they don't have big commercial deposits, so it doesn't matter. They can keep being little banks. But those big little banks, those are the ones that are going to have to get acquired. plug and play growth stocks, almost done. I've got a couple of new names for you. I'll have this done tonight. And I just showed you the March options expiration. I had it somewhere else. I will include some of Shooter's charts from the primary wave setups that he does. A lot of these are a little swing tradey, so I'll just include the ones that are a little bit more longer term in nature. But beyond that, are there any questions? Somebody asked about Heron Therapeutics. We've talked about that a couple of times. They have activists that are in there now. The products are good. They just have to monetize things better. And they have people in there helping them. The researchers and doctors that built that company haven't been great at getting distribution. They're going to get it distributed. There's not a lot of solutions for the opioid crisis, and Heron Therapeutics offers one. At some point, the government puts the screws down on the prescriptions of opiates even more, and that will be a catalyst for Heron. You don't know when that catalyst happens because you don't tell the government when they have its policies. But I would say in the next 2-3 years, just like Ametis, just like Heron, just like we saw with Travel America, 2, 3, 4, 5 years out, you get ahead of these catalysts, you get these super cheap prices, like all the satellite stocks. You just get ahead of things by 2, 3, 4, 5 years, and you let it just sit. And in the meantime, you sell options. You have your blue chip part of your portfolio that's for, tracking the index, and away you go. All right. I am going to write a piece about the satellite stocks. That is already on the list in here somewhere. There you go. Already coming. Satellite as a service is launching towards $1 trillion industry. Somebody says it's like barbecue. Just let it cook low and slow. That's right. At some point, it's delicious. All right, I'm going to finish on that. Have a great day. I'll get this edited, and I'll get all these articles up. And like I said, I've been moving more and more towards my Alexander Hamilton, writing like I'm running out of time. And I kind of am. I'm going on a trip in May, so I've got until May 1st to get you everything that I want to get you. Then I'm going to take 2 weeks off, and I'll see everybody who I'm planning to see in the San Francisco area. If you're in the San Francisco area and you'd like to meet up, make sure you send me a message. If there's enough of you, we'll do kind of a group thing. All right, take care.